Now we are moving on to bond valuation segment. Now questions related to bond valuation. See, question number 19. Nominal value of 10% bonds issued by a company is 100. The bonds are redeemable at 110 at the end of year 5. Determine the value of the bond. If required yield is 5%, 5.1%, 10%, 10.1%. 4 different options given. See, what is value of the bond? This is regarding valuation question. Value of a bond is nothing but present value of future cash flows arising from the bond, okay, discounted at required rate of return. Value of any asset is present value of the future cash flows discounted at required rate of return as per a discounted cash flow method. Now here what will be the bond cash flows? Now what will be the cash flows arising from the bond? Okay, coupon, bond will pay the coupon every year, annual interest it will pay if at all there is coupon. Okay, then it will have redemption. Are you understanding? So routine, what will be the cash flows from bond? Coupon will be there, then will be redemption. Up assume if this is what 5 years bond na, so 1 2 3 4 5 years you will receive coupon. At the end of 5th year redemption will happen. Are you understanding? So any bond valuation segment we have bond triangle, you need to understand what is happening. See, one is the one angle is nothing but bond cash flows, which I say coupon and redemption, correct? And then you have value of the bond, okay, value of the bond, or I can say fair price or market price also, fair market price. Sometimes interchangeably they use the market price in the question, sometimes they will ask us to find the value. Okay, it is assumed that the market is the market price is fair price. Are you understanding? This is bond triangle wherein, okay, bond question there are only 3 things. Bond cash flows will be given. Why? Because fixed income security, the cash flows will be fixed in nature. Okay, it will not change. A coupon percent it will be given in the bond itself. Okay, what is the coupon the instrument is going to pay? What is the redemption value? Everything will be printed in the instrument itself. Are you understanding? Fixed income security, na? So there will be no ambiguity there. So bond cash flows will be given in the question itself. And okay, if the question is regarding value, okay, they will give the YTM, or this is discounting rate. See, present value of future cash flows discounted at required rate of return. This required rate of return of bond holders, I call it as YTM, yield to maturity, which means if I discount the bond cash flows using yield to maturity, I will arrive at the value of the bond. Okay, see, now bond cash flows will be given in value based question. If the question is regarding value, they will give you bond cash flows anyway, it will be given in the question. They will give you the discounting rate. Just apply the discounting rate, discount the bond cash flows, you will arrive at the value of the bond. If the question is regarding YTM, okay, they will be giving bond cash flows anyway be given in the question. They will be giving you fair value of the market price will be given. Okay, they will give you the value of the bond, or they will give you the current market price of the bond. Okay, and you need to find the IRR. This is nothing, YTM is nothing but like IRR and capital budgeting you compute na. Okay, the rate at which the discounted cash inflows will become equal to discounted cash outflow. In case of bond, the discounted cash outflow is nothing but market price of the share. You need to pay this much to acquire the share, correct? Then what will be the inflow? The bond cash flows will be the inflow, the series of inflow. Coupon, okay, 5 years and a 5 years coupon. At the end of 5th year, you will get the redemption. Are you understanding? So this is value based question, simple question. Coupon is 5, you should apply on the face value. Coupon 10% they have given. Okay, 10%. Now this is coupon rate. You will now nominal value, face value 100 10%. Now 10 rupees is the coupon. 10 for 5 years you will receive. At the end of 5th year, redemption. Here only I need your attention. Redemption might be a par value or discount value or premium. It will be given in the question. You should only consider that amount. But in this question, it is redeemable at 110 premium amount they are asking. So when you put bond cash flows, you should put 110 and not 100. Don't get confused. This 100 is just to compute the coupon. Coupon rate you should apply on face value, but redemption you should take it separately to discount. Are you understanding? Okay, now simple straightforward bond valuation question. Case A, if yield is 5%, which means discount rate, or YTM, yield is YTM, yield to maturity, okay, 5%. Now what do you do? Year 1 to 5, 5th year. Okay, this is annuity, this is present value factor, this is present value annuity factor. No, this is present value annuity factor, this is present value factor at the end of year 5. You will arrive at the value of the bond. Okay, case 2, 5.1%, discounting factor 5.1%, nothing new. Discounting rate you change and find out. Discounting rate they are asking, different discounting rate given, find out the value. Next, nothing is given, nothing big in this question. Okay, no need to practice. Okay, question number 20, simple straightforward question. An investor is considered the purchase of the following bond, face value given, coupon rate is given, maturity period is given. If he wants a yield of 13%, what is the maximum price he should be ready the which means at 13%, if he wants 13% return from the bond, if he wants the yield to be 13%, the discounting rate will be 13%, which means what is the value of the bond? Again, value of the bond. Question, simple, straightforward. First to compute value of the bond, calculate maximum price. Here, see, that is why here also, this question also, you can also present it this way. No issue, tabular format. 1, 2, 3, okay, like this. Here 1, 2, 3, 3. Okay, like this, present value annuity factor, present value factor, compute present value of the bond. You can find it out. Or you can simply write 11 coupon into 3 years present value annuity factor and redemption. Here, in this question, anything given about redemption, see, when in the bond valuation chapter, nothing given about redemption, you should always assume that it is redeemed at par. The bond is redeemed at par. Nothing given in the question, so we will assume that it is redeemed at par, right? So 100 they have taken into 13% 3 years. What is the discounting rate? And you will get the value. 95.27 is the value. Okay, next segment is only important. See, mark this segment as important. If the bond is selling at 97.6, what would be his yield? Which means, same way, I told you the bond triangle, bond cash flows you already know. But what they are asking, this is regarding YTM. And they have given market price, which means at the current market price, if the market price of the bond is currently trading at 97.6 in the market. If this is the market price, which means this will be your outflow, right? And you know the inflow, this is the outflow. For 3 years, you know the inflow. Equate it, IRR, okay, you need to find out. Very simple. IRR, interpolation, you only, see, IRR, how can you find out? There is only one way. There is YTM, there is an approximate formula by which you can arrive at an approximate YTM. Then you need to do interpolation and find out exact YTM. Otherwise, IRR computation, only trial and error method is possible. You know, capital budgeting, CA intermediate, already you would have studied. Okay, IRR, okay, you only can do the interpolation and find out. Trial and error method only can be applied. But YTM, there is an approximate formula which I will discuss. See, what is the YTM approximate formula? Interest plus amortization divided by average price. Interest plus amortization divided by average price. I will elaborate. This is nothing but interest. I just apply it and I get the interest plus amortization. You see what is happening. This will, see, bond is there. The income from the bond will be generated from two sources. One is coupon, other is capital gains or loss, if any. See, very simple. Initially you bought the bond at par value, but while redeeming they are giving the premium. If assume the bond is redeemed at premium, up 100 is the issue price, redemption price is 120, which means 20% you are making the capital gain. All this I have explained in my revision video. There you can go through. I don't want to get deep into concepts, but understand that two sources you will receive income from the bond, correct? Interest, coupon and the capital gains. Here the capital gain is earned over a period of life of the bond, which means 3 years bond is there. Over a period of 3 years you are earning the gain of 20 rupees, assume in our example, correct? Is not for one single year. Coupon is for every year, but the capital gain is for cumulative 3 years period, correct? So what do? You amortize it for 3 years. Simple. First you need to compute redemption value minus issue price or the subscription price. Redemption price minus, I call it as subscription price, divided by amortization, number of period. Okay, period of the bond, N, I can call it as N. This will give you the amortization. This will be the amortized capital gains each year you earn. Okay, rough method, not applying time value of money. This is why this is approximate, which will not consider time value of money with respect to capital gains. So this is approximate formula. That's why it is approximate. Yeah, when you compute time, when you consider time value of money, you will get the real IRR. Okay, but then approximate IRR will be little less or high. Average price divided by average price also, I can write simply redemption value plus subscription value divided by 2. Simple average, you just calculate, and if you calculate this, you will get the approximate YTM. This will be approximate YTM. Okay, institute have presented this way. See here what they have done now. See, at 12% value they have found out. At 13%, this is the value. What is the, yes, 12%, 97.62 is the value. 13% which is less than that. Here in this question, at 97.62, they have given straight away in this question. So this is, you can find out this. That is not an issue. But 12%, how to consider this 12%, a question will arise. Correct? 2 ways to do it. Apply the approximate formula first. Okay? Plus or minus, you apply 1%, you will get to know. Very simple. Bond and value and YTM have inverse relationship. Correct? in this question, if you see where this question, yes, the number of shares that can be repurchased, no, sorry, this is not the question. Yes, at 13%, okay, what is the maximum share price now? We found out some number, correct? What was the number at 13%? What was the value per share? 95.27. See, at 13% YTM, the value comes to 95.27. They are asking, what is the YTM when the market price is 97.6? Which means the price is increased. YTM should be lesser, higher, lesser than 13%. Then only the value, you have to increase value na. From 95.27, you have to increase the value to 95.6 na. What you should do? Reduce the YTM. Apo 13%, next go to 12% and check it out. This is what they have done, and 12% it is tallying. Instead of that, put that 12% is the YTM. But ideally, approximate formula you should use, because sometimes 97.6 it is matching, hence they have given. How do you know that whether I should take 12% or 10%? Are you understanding? Starting point will be difficult. So what you do, apply the approximate formula, then you will find out the starting point, where to start the interpolation. Are you understanding? You will get the rough number of what is the approximate YTM, then you do interpolation, find out accurate one. See, very simple, interest 11 plus, okay, redemption value 100 assumed to be redeemed at par, minus subscription price. Here current market price will be the subscription price 97.6 divided by 3, n number of years, the whole divided by redemption price plus this divided by 2, simple average price, denominator they have taken, and they have found out 11.94 as the approximate YTM. Okay, then approximate na, you can check it out at 12%, you will get the exact YTM, right? Next, moving on to the next question. Okay, this question you can mark it as important, since 1 star is enough, because of course YTM, simple computation only. Next, calculate market price of 10% Government of India security currently quoted at 110. But yield is expected to go up 1%. In the question, the market is important. I call this question is important because of one unique adjustment. Conceptually, it is not good to say like this, but they have done like this. Okay, the solution differs. Inge, what they have done now, the yield expected to go up 1%. The yield which they are referring is current yield. There is a concept called as current yield. Okay, it's nothing but coupon by market price of the bond, market price per share, market price of the bond, market price of the bond. Okay, this is current yield. This is something similar to dividend yield. You see, income of the bond arises from two sources. One is dividend, other is capital gain. But the current yield ignores the capital gain income. Just like your dividend yield in the share, okay, you have dividend yield. What is dividend yield? Dividend per share divided by market price per share, correct? This ignores the capital gain, the capital appreciation of the share price, correct? So that actually is not fair, because the income from the share investment, okay, will be coming from two sources, and this what do you say, this yield will ignore the capital gain portion. Of course, it is not correct, but always, that is why YTM, always you should discount the bond cash flows using YTM and not using current yield, because YTM is the benchmark. Why? Because YTM will include, all the things, will include the impact of coupon as well as the capital gain. Okay, time value of money also will be considered, not like approximate YTM. I am saying about IRR of the bond cash flows. Okay, that is the accurate method. IRR of the bond cash flows, YTM only you need to discount. Okay, use to discount the bond cash flows, but here they have used the current yield to discount the bond cash flows. I will explain how it is. Okay, we can't do anything. You should take this as current yield and not YTM. Okay, see, very simple how they have solved. 10% Government of India quoted. Quoted market price is 110. Yield is expected to go up by 1%. Okay, what they have done now, very simple. Current yield, first they have computed existing yield, current yield. This current yield is technical current yield, like dividend yield I am saying. Okay, current YTM you should not think. See, YTM also on a daily basis it will keep on changing. So you should not get confused with current yield and YTM. Current yield, okay, technical current yield is nothing but coupon by current market price per share, coupon interest divided by market price. How much you will get? 10 is the coupon, y 100 is the face value, 10% is a coupon. Applied to the market price, you will get the 9.09 as current yield. Now, if this current yield goes up by 1%, how they have done now? Current yield goes up by 1%, now it will become 10.09%. Then what will be the market price? Very simple. Okay, market price is nothing but coupon by market price per share. This is current yield. Now current yield goes up to 10.09, you should equate, coupon will be remaining same, which means you equate MPS is nothing but, okay, coupon which is 11 10 divided by 10.09. 10 divided by 10.09. Are you all getting 10 divided by 10.09 percentage? 99.11. This is the market price. This is how they are done. Are you all understanding? It's all about current yield, okay, and not YTM. Okay, this yield they have taken as current yield. That's the only thing you need to remember. This sort of question if comes, you should remember that the yield is current yield and not YTM. Okay, a bond with 7.5% coupon interest, face value 10,000 and term of the maturity is 2 years, presently yielding 6%, interest payable half yearly. Okay, the half yearly bond only is the, wherever the question is regarding, you know, half yearly or quarterly, where the term of the maturity is not 1 year, what you should do now, you convert, okay, you see, you convert the entire data. You convert the entire data into periods, which means, see, what you should do, 6 years is the bond maturity period. Assume 6 years is the bond maturity period. Here, instead of paying coupon annually, if the company pays coupon half yearly, which means you will get 12 periods now, every 6 month period. You should consider 6 months period. How many 6 months periods are there within a period of 6 years? 12 6 months period. Apo, what you should do? You should convert the entire data to 6 months period and then you solve the question. Are you understanding what I am trying to say? YTM assume is 10% per annum. Correct? Everywhere in our subject, wherever they have given interest rate, okay, it is to be assumed as per annum. If a YTM is given 10%, okay, it's assumed to be per annum. Now what you should do, convert it into 6 months period YTM. 1 year YTM is 10%, say 6 months YTM, assume it to be 5%. But discounting, when you discount the cash flows, what you should do, convert the discounting rate to 5%. Use 5% discounting rate, correct? Now, you convert, years will be 1 to 6 na? What I will explain it. Okay, assume it is 6 years, right? Semi-annual coupon, right? Or half yearly coupon paying bond. Correct? How to find the value? Very simple. What you do? How to present na year cash flows. Okay, year will be there na. This will be replaced by period. Okay, 6 months period term. Like this you convert it. Cash flows, present value factor at discounting rate and PV. This is how you find out na. Here 1 to 6. Instead of 1 to 6, you put 1 to 12. 12 periods are there. Correct? Cash flows, instead of annual cash flows, you will consider the half year cash flows. Coupon, every half year will be paid. How to do it? Very simple. Okay, face value multiplied by coupon rate will be annual rate. That divided by 2. If 10% is a coupon, 100 face value, 10 rupees is the annual interest. Now 5 rupees will be the half yearly interest. Take the half yearly interest as cash flow. Present value factor and yield is, suppose 10% is YTM. This divided by 2 you do. Okay, at 5% you discount and find out the present value factor and find out the total of the PV. Are you understanding? This is how you will find out the value of the bond in case the question is mentioning, okay, to consider the half yearly periods. Okay, the coupon, the bond is paying the coupon half yearly or quarterly, you will convert the data, right? A bond is on, so how they have solved, very simple and straightforward only. See, question number 22 or 21. Yeah, 1 second, they have also asked one more segment in the question number. No, same question only. A bond with, yes. Presently yielding 6%, interest will pay. Now what they have done, yes, see. What they have done, see, present value of interest, present value of principal. Okay, simply they have done and found, okay, see, here you need to show, this is not enough. For examination, you need to present how you arrive at present value of interest, how you arrive at present value of principal, you need to show. Okay, like this you use in the question, I will tell you what to do. In this question, bond is paying 7.5% coupon. What is the yearly coupon is 7.5%, 75 rupees is coupon, correct? Okay, 75, or face value 10,000, see here, 10,000 into 7.5, 750 divided by 2. How much is that? 375, which means the cash flows will, you replace it with 375. Okay, 1 to 2, 6 years, is this 6 years? Maturity of 2 years. So 4 period, 1 to 4, year, see, period, okay, 1 to 4, cash flow, I write it as 375, okay, present value factor, what is the yield of this instrument? 6%. So what I will do, half yearly na 3% and discounted cash flow or present value of this bond. How to find out na? See, very simple, year 1 to 4 and at the end of year 4. period 4. Okay, cash flow is nothing but 375. What is the redemption value? Anything given? Nothing given. Assume to be at face value. Okay, 10,000 is the face value which will be redeemed. 10,000. Okay. Now, present value factor at 3%. 1 divided by 1.03. Okay. Is equal to grand total. You have to find out present value annuity factor and present value factor, and then discount it. You will get the value of the share. You solve it. Here what they have done now, this total will come to, see, this total will come to 1394. You can verify 1394. This will become 1394, and this amount, present value of this will be 8885. This alone we can verify. See, 1 divided by 1.03 is equal to 0.8884. This is correct. 0.8884. Present value factor at 3%. How you are getting? You need to show the calculation. Okay, that is what I have done. You will get the 8885. Okay. Next, question number 22. Take question number 22. A convertible bond with a face value of 1000 is issued at 1350. Okay, with a issued at premium. Okay, with a coupon rate of 10.5%. The conversion rate is 14 shares per bond. The current market price of the bond and share is 1475 and 80 respectively. What is the premium over conversion value? See, this is a concept regarding convertible bonds. Okay, I am not discussing concept in detail. Please understand, we have time constraints. So what I will do is that I will assume that you have understood the concept. Okay, for concepts you go through my revision lectures. Okay, here I am just revising the questions. So see, the conversion value of the bond means it is nothing but stock value of the bond. Wherever question is premium over conversion value, simply they have given premium over conversion value. Now it is to be regarded as stock value of the bond. Stock value of the bond. There are three values. I'll just tell you. Okay, there are three things here. See, I'll tell you there are three values. One is that share value of the bond, or conversion value. This I call it as conversion value. This is plain value of bond, without the conversion option. Okay, without the conversion option. Plain value of the bond without the conversion option. Next, current market price of the current market value of convertible bond. Market value of convertible bonds. Okay. Now, you need to understand that when they ask about premium, clearly understand, when they ask about premium, there are two types of premium which is being tested. There are two types of premium. When they ask simply premium over, what is that? Premium over conversion value. Premium over the, what is the premium over conversion value? Na? Very simple. Okay, current market price of the bond and share, yes, current market price of the premium over conversion value, you see, premium over conversion value, they have given exactly conversion value, they have given specifically conversion value, not an issue. What do you do? Always remember the plain value of the bond, if assume is 700, plain value of the bond is 700, share value of the bond will be 750, convertible bonds market price will be always higher among all these three. Are you all understanding what I am trying to say? That market price of, because convertible bonds will give you both option, to convert as equity share, so which means whenever you want, you can convert into equity options. So that is giving a choice, the benefit, extra benefit is there. Hence, it will always be traded at a premium price in the market. Are you all understanding? The price of the convertible bond will be highest among the all three. Correct? Plain value of the bond, which means the bond without having any conversion option, simply plain bond, if you see, not a convertible bond, which will have a lesser value. But stock value of the bond will be higher than plain value of the bond, but will not be higher than convertible bonds. This is the issue. Are you understanding? See, now when the question is asking you premium over conversion value, what you need to compare, very important, this number and this number, which means 750 is the amount, a premium, 800 divided by 750, which means 800 by 800 by 7, say very simple, how much premium, 800 minus 750, 50 rupees, the 50 rupees is the premium, from where, how much you need to base, 750, so 50 divided by 750, in percentage terms is the premium you need to pay to buy a convertible bond, to buy a bond which is having convertible. But this is premium over the conversion value of the bond, which is 750. This is one type of question. They may also ask premium over plain value of the bond. Are you all understanding what I am trying to say? When they ask, see, if the question is specifically mentioning conversion, premium over conversion value of the bond, you need to compare these two. You need to compare these two. Agreed? But when the question is asking specifically about plain value of the bond and the current market price of the bond, then you specifically compare plain value of the bond and convertible bonds market price. That is not an issue. But when question is simply asking you what is the premium of this convertible bonds, there are question. Okay, I have seen the question. There is one or two questions I think given in RTP. Okay, in our module I have given that. When they are giving, okay, just to find out the premium of this convertible bond, you should always assume that this premium is over and above the conversion value and not the plain value of the bond. This you need to remember. Okay, that is why I am mentioning here, because in the study mat questions, that question may not be here. But I have seen that question, hence I am saying this adjustment you need to remember. I don't know whether they have given or not. Yes, listen to me children. Now see, they have simply given conversion premium. They have simply given conversion premium. Of course, they have simply given conversion premium. Now, okay, see, conversion premium, you should always compare conversion value and current market price of the convertible bond and not plain value of the bond. There is a question which specifically asks regarding premium over plain value of the bond. There you should not get confused with conversion value. You should compare with plain value of the bond and then with plain value of the bond with current market price of the convertible bonds. Okay, see. There is one big question in the RTP and past examination question is also there. I don't think institute has included it in study material. Yes, this is not in study material. One bigger question will be there with 8 subheading. Okay, yes, this is simple question. That question is a comprehensive question. Okay, in that question you can see that premium over plain value of the bond will be given in the question. There you should compute premium over plain value. Right. Now, what is the premium over conversion value? Premium over conversion value. First, you need to find out what is premium over conversion value. Simple. See here. See, conversion rate you need to find out. How many shares have been allotted? First, conversion value, stock value of the bond. Stock value, I can call it as conversion value also. Okay, conversion value or stock value of the bond is nothing but number of shares which is allotted for one bond. How many shares are allotted? 14 shares. Correct? 14 shares into, okay, number of shares per bond into market price of shares, market price of equity shares. How much is that? 80 into 40, 1120. Up 1120 is nothing but the conversion value in this question. 1120 is the conversion value. Current market price is how much in the question of the convertible bond? 1475. Market price of bond, current bond is 1475. Up 1475 and 1120, you should find the difference. 1475 minus 1120 divided by 1120. Okay, how much is that? 1475 minus 1120. This is 355 divided by 1120. You get a premium as 31.7%. Are you all understanding the solution? Here, one more adjustment is there. I have seen in MCQ, ICAI BOS portal. Okay, there is a BOS app. The app, the MCQs are given. There, what they have done, they have committed a mistake regarding how to find the conversion. Same question. One of the question, what they have done, instead of the numerator 355 is okay. The denominator they have taken as 1475. Are you all understanding? The premium over conversion value, the denominator they have taken as market price of the debenture, which is not correct. But in one of the MCQs they have done that. Okay, I've seen that it is not correct. But what you should do, Institute, if you see in the examination, if the question is being asked, this conversion premium percentage is asked, carefully observe what the choices are given, right? You compute the 1120 divided, you do the 355 by 1120, 31.7%. Okay, there is, see, if the choices are given 20%, 25%, okay, 32%, none of the above would be given. Don't mark 32% or none of the above. Are you understanding what I am trying to say? Which means none of the above mark, you should not go and write none of the above come, because here I am not getting the solution for all three. Hence the fourth, none of the above, let me select and don't select. Also compute for the market price. Also compute market price, which means 355 divided by 1475 also you do. Find out the premium percentage. If that percentage is given in one of the choices, select that choice. Are you all understanding? Select that choice. Okay. If both the choices are given, and I don't know what the solution would be. Okay, you have to do inky pinky and select one choice. I have no other option. Okay, there is an ambiguity. Just wanted to highlight one of the MCQs they have done like this. Okay, if debentures anyway, if the same question is asked in descriptive, easily you can give a note. There is no harm in giving note, but MCQ you cannot give note. You just need to select the solution. Hence, I am telling you. Okay, if debentures are not converted. Okay, this is next question. Yes, question number 23. Question number 22 is over. Just a premium or conversion value they have asked. Okay, I think question number 24 is more comprehensive than question number 22. Right, question number 22, take question number 23 for discussion. Saranam Limited has issued convertible debentures with coupon rate of 12%. Each debenture has an option to convert 20 equity shares at any time until the date of maturity. Debentures will be redeemed at 100 on maturity for 5 years. An investor generally requires a rate of 8% per annum on 5-year security. Okay. As an investor, when will you exercise conversion for given market price of the equity share 4, 5 or 6? Past RTP question, very good quality question. Market as important. Very good question. Market as important. Simple only, but it needs to strike. In our paper, the only problem is that, okay, you will know the solution, easily solve the solution within minutes. But sometimes the formula or sometimes the methodology of solving the question, it needs to strike you during the examination. Okay, the exam hall, within the 3 hours, it needs to strike you. Okay, this question is a unique question where what you need to do now, you need to compare the share price with respect to the value. Okay, different share price is given, 4 rupees, 5 rupees, 6 rupees, which means at 4 rupees, if the 4 rupees is the share price, if the company's share price is 4 rupees, you will consider how many shares are being given for every bond. Okay, number of shares into the share price, correct? You will find the conversion value. This conversion value, you will keep on comparing with the value of the bond. At 4 rupees market price of the share, you will have the different conversion value, you compare it the value of the bond. At 5 rupees, you compare the value of the bond. 6 rupees, compare it the value of the bond. Tell me children, when will you exercise the option? See, this is nothing but an option, conversion option. This is nothing but bond having an option to convert, which means when will I convert? Whenever situation is favorable. Very simple, yeah. Whenever the equity shares are performing well, the company is performing well, okay, I will like to become a shareholder rather than a bond holder. Because fixed income security, if the company is growing at a 20% rate, if the company is doing exceedingly well, okay, you will never get a share in profits as a bond holder. As a bond holder, you will only get a fixed amount of return, correct? Now, when the share price is appreciating, I would like to become a shareholder rather than a bond holder, which means if the conversion value is more than the bond value, I will exercise my conversion. Okay, I will exercise my right and then option, and then I will become a shareholder rather than bond holder. Are you understanding? So I will compare and find out at first step in a find the value of the bond. First step, find the value of this instrument, bond instrument, convertible bond instrument. You find the value, present value of all the future cash flows discounted at 8% they have given. Okay. Then you compare at each stage how many shares are being issued for this bond, you will find out into market price 4, 5 and 6, you will make a decision. See here, very simple. First, interest 12 years, 5%, 8% discounting rate, interest, okay, you will find the present value of interest, present value of redemption 100, you will find 116.02 as the fair value of the convertible bonds, fair value of the convertible bond. Not now what you do, see. At market price 4 rupees, number of shares will be same. Number of shares allotted for each bond will remain same. It will be given in the instrument itself while giving you the conversion option, correct? Upper 20, number of shares will not change. 20 into 4, 80. Okay, 20 into 5, 100. 20 into 6, 120. You tell me children, if the value is 80 rupees at 4 rupees market price, will you exercise your right? No. Why? Because the bond value is higher than the equity value. You will never exercise. At 100 also you will never exercise, but at 120, okay, if equity value becomes 120, I will exercise my right. When the share price is 6 rupees, I will exercise my option to convert and I convert. Okay, hence unless the market price is 6 rupees, conversion should not be exercised. This is the question. Okay, market as important, any unique type of question. Okay, the data given below relates to convertible bond, simple and straightforward. Face value given, coupon rate, number of shares, market price, straight value of the bond. This is plain values. Whenever I say straight value now, okay, also may be referred to as plain value of the bond. Okay, without conversion option. Market price of convertible bond, this is the current market price of convertible bond. If you observe, there are three, okay, prices. I'll say there are three prices of the bond. See, I'll tell you. Face value, leave the face value. One is the market price of convertible bond, which is 265, correct? Now, one is that straight value of the bond, which I call it as plain value in the, one second, the previous, I showed you in the previous this, na? Yes. Here, conversion value, plain value, current value, which means current market value, market price of the convertible bond. In the question, this question, you need to see here, this is plain value, see, conversion value. First one is conversion value. I can put it as plain value, same way. I am not changing the sequence so that you will remember this, plain value, and this is market price of convertible bond. Okay, this convertible bonds market price. This is share value of the bond or stock value of the bond or conversion value. I call it as conversion value. How much is that? This question you need to see how many shares are being allotted, number of shares per bond, 20. 20 into market price per share, 12. Upper 20 into 12, 240, yeah. 20, yes, 240 is the conversion value of the share. Plain value of the share, 235. Market price of the share, 265. Are you all seeing? Three prices is very, very important. Here, market price of the convertible bond will always be traded in the premium. Always be traded in the market at premium price. Okay, of all three, which will be very expensive, which will have conversion option. So this will be always in premium. Now, what is the stock value of the bond? Simple stock value of the bond, number of shares into conversion, which is number of shares into market price of the shares, 240. Agreed? Solution itself I am telling you. The percentage of downside risk, you tell me children, what is percentage of downside risk? You tell me. Initially, you buy the conversion, the bond, convertible bond by paying 265 rupees. Now, when will you not exercise the equity shares? Very simple. Okay, see, when the company is performing well, you would like to exercise your right, correct, and convert the bond into equity share. And if the company is not performing at all, share price went to zero. Okay, company, they shut down the company. Now you tell me, you would like to die as a bondholder, na? Why? Because at least some amount can be recovered. Are you understanding? Okay, now you tell me children, what will happen? The percentage of downside risk, how you need to compute? You see, if the value gets eroded, the share value gets eroded, okay, it will be equivalent to plain value of the bond. Are you understanding? Up from 265, it may drop down to 235. Are you understanding? There, for computing conversion premium, you compare these two, but for computing downside risk, you should compare market price of the convertible bond and plain value of the bond. Why? Because once the conversion is not feasible, stock price is falling, conversion is not at all feasible, okay, there is no choice of conversion left. What will you do? It will become worthless. In the conversion value will be removed. See, very simple. The convertible bond, there are two things. Plain value of the bond will be there, plus premium, okay, for conversion. The option, premium for conversion option, correct? Additional option. When this option is not at all feasible, this will be worthless. The value of the convertible bond will drop back to plain value of the bond, which is 235, which means the downside risk is nothing but 265 lane. How much it can reduce? 30 rupees it can reduce. Up at 30, whenever you are computing the percentage of downside or upside, wherever you are computing, from which number you are trying to compute, that number you should put as denominator. Just for clarification, you might know that, no issues. 30 divided by 265. Up from 265 only it is falling. Downside risk from, what is downside risk? Price falling from higher, price is falling from the higher rate, correct? 265 and the price is falling up to 235, which means maximum fall can happen up to 235, 30 rupees, correct? 30 divided by 265. How much is that? You find out the percentage. I will tell you how much is that. 30 divided by 265, 11.32. This percentage downside risk 11.32%. 11.32%. That's correct. Compute panirkana pakra. Institute solution. They are given correctly. Yes, conversion value of the stock is 240. We already know that. Percentage of 11.32. This is correct. Yes, correct. Conversion premium. What they have done? Yes, of course. Conversion premium. Now also they are asking conversion premium. Already we solved it. Okay. What? 265 minus 240 divided by 240. Yes, this is correct. The denominator 240 is correct. In some question I told you, they have taken 265. That is wrong. Okay, 240 you should take, because a premium you will pay. Initially you need to pay over and above the plain, what is the conversion value, right? Say conversion premium. Next, fourth, what they are asking? The conversion parity price. What is this conversion parity price? Very simple. You see this conversion parity price is nothing but market price of the bond. How much is the market price of the bond? 265 divided by, okay, 20 shares per share. See, what is this conversion parity? It is nothing but a share price. It is nothing but share price. What is conversion parity price? It is nothing but share price, but equivalent share price, which means what should be the fair price, okay, for the given number of shares for conversion, which means 265 is the convertible amount price, bond price, divided by number of shares. How many shares be allotted for each bond? 20 shares, which means the conversion parity price is the price at which I am indifference between the conversion option and the bond option. Are you all understanding what I am trying to say? That is nothing but 13.25. Very simple. Yeah, this is at this current market price. If equity share price jumps to 13.25, current market price is 12 rupees per share. Equity share 12 rupees given in the question. If 12 rupees of the current market price of the equity share jumps to 13.25 in the future, I will be indifferent between holding the equity share or holding the convertible bond. Are you all understanding? This is called as conversion parity price. Okay, break-even price. This indicates that if the price of the share rises to 13.25, from 12, the investor will neither gain or lose on buying the bond and exercising it. Okay, observe that 1.25 is 10.42 of 12, the conversion premium. They have given, explained, that is fine. Okay, next, 1 second, I'll just rub this. Okay, see. Okay. Take question number. Okay. Take question number 25 for discussion. Very, very important question. Very, very important question. Mark it as 3-star. Okay. You can give us 3-star question. Very good question. Mark it as important. ABC Limited has 300 million 12% bond outstanding with 6 years remaining to maturity. Since interest rates are falling, ABC Limited is contemplating of refunding these bonds with a 300 million issue of 6 years bond carrying a coupon rate of 10%. See, this is a question of bond refunding decision. Bond refunding decision. Okay, see, what is the agenda for this question? Very simple. Okay, the company will issue callable bonds. These are called as callable bonds, which means, see, assume today market interest rate is 14%. From 14%, it has dropped to 10%. Now, in market interest rate is 10%. Are you understanding? Which means, okay, the company, if the company issued bond at 14%, correct? Which means on its outstanding debt, it has to pay 14% interest, correct? For 10 years or 20 years, long-term bonds. But what happened? After a few years, okay, the company, the interest rate dropped to 10%. In this case, see, if I issue today these bonds, long-term bonds, I would have issued at 10%, but since I already agreed at 14%, okay, current market interest rate is very less, hence I am losing 4% interest by issuing these bond. I have to pay additional interest. This is loss to the company. Are you understanding? So, which means when the company is anticipating the fall in interest rate, it issues a callable bonds. It issues a callable bond, which means the bond can be called back. The bond can be called back. It will have an option to call back the bond, old bond, which means the old bond carrying 14% interest rate can be replaced with 10% interest rate, which means this is bond replacement decision. I can also call it as bond replacement decision. I replace the old bond which is carrying a higher interest rate with the new bonds which is having a lower interest rate, correct? Now, what is the question here? You have to do the cost benefit analysis and you have to decide whether to call back or not, whether to issue these new bonds or not. This is the question to be answered. How to compute the NPV? Very simple. You calculate the total outflow, initial outflow. Then you will calculate the series of inflow which is going to happen, which means cost you will calculate, benefit you will calculate. Okay, present value terms you will calculate, and if the present value of the benefit exceeds the present value of cost, you will call back the bond. Very simple. Is something similar to capital budgeting, where you will compute, okay, discounted cash outflow minus discounted cash inflow minus discounted cash outflow. Okay, you will arrive at the NPV. If NPV is positive, net present value is positive, you invest in the project. Like that here also, if NPV is positive, you call back the bonds. If NPV is negative, okay, don't call back the bond, refund or replace the new bonds. This is the situation. Here what they are saying, ABC Limited has 300 million okay, worth of bonds, 12% interest carrying bonds outstanding with 6 years remaining to maturity. See, today what happened, this is initially how many years it was issued for, okay, it is given these bonds with the issue of 6 years bond coupon carrying, say, see, now the six years remaining to maturity, how many years gone by, they have not mentioned, no issues. See, assume I have 10 years bond, total 10 years period. What happened? Okay, year 1 to 4, assume this is 4 years. Okay, year 1 to 4 years already elapsed. We are today standing at the end of year 4. Now 6 years remaining till the maturity of the old bond, which means existing bond. Correct? See, this is carrying 12% interest rate and 6 years remaining to the maturity. Since interest rates are falling, ABC Limited is contemplating to refund this bond with a 300 million issue of 6 years bond. See, this can only be done. See, when you have issued this 14% interest, it can only be done when you issue it as a callable bond. Are you understanding? You cannot suddenly change the interest rate and issue. That is the understanding, which means after the company already thought about it and issued a callable bond. Thereafter, after 4 years, okay, now the company is thinking, when the balance 6 years is there, company is thinking to recall back the old bonds. Okay, ABC is contemplating of refunding this bond with a 300 million issue of 6 years bond, of course, with a new bond. Now, new bond is being issued for balance 6 years period, which means already 4 years happened, 10 years bond, the 10 years bond I will close. But instead of that, I will reissue, okay, a 6-year bond, which is having a life of 6 years, okay, carrying coupon rate of 10%. Issue cost of the new bond will be 6 million and the call premium is 4%. Of course, see, whenever they are refunding, you cannot refund. 300 million is the total value, face value of the initial issue, bond issue, correct? Now this 300 million, when you redeem it, you cannot redeem it by simply giving it 300. It should always be redeemed at premium. The callable bonds, when you are refunding the bond, okay, bond holders will never satisfy it if you are redeeming at face value. Are you understanding? Okay, you should replace only when you redeem the callable bond at, okay, some premium. This they have given us 4% premium, which means over and above the 300 million, you have to redeem at 4% premium. 9 million being the unamortized portion of issue cost of old bonds can be written off no sooner the old bonds are called off. Once the old bonds are called off, you can write off the, okay, 9 million unamortized portion of the issue cost. See, 4 years back today, okay, 4 years back from today, you would have issued this bond at that time, okay, 9%, whatever is the issue cost. Issue cost would have been amortized over the life of the bond. Say, okay, you have 30 million, assume you have 30 million issue cost. 30 million issue cost for 10 years. Now, every year 3 million you have to amortize, correct? Some number, the balance number only is relevant. What they have given, 9 million is the unamortized portion of the issue cost of the previous bond, old bond. That portion, okay, will be written off instantly, which means a new bond, when old bonds, no sooner than old bond are called off, now you are trying to call off the old bond, so which means now itself you will amortize, or you will amortize it, put it in the P&L, amortize it, you will write off in the P&L. Are you understanding? Marginal tax rate is given as 30%. You are required to analyze the bond refunding decision. Simple calculation. Okay, once you are, I will explain the calculation. Once you are through with that, everything will be thorough. See, okay, initial outlay, calculation of initial outlay, which means initially what will be the outlay today if I refund the bond. See how you should think. If I refund the bond, I have to pay back the old 300 million cost, correct amount. So what will I do? If I refund the decision, all these are, okay, you are computing NPV by keeping in mind what would be your outflow and inflow if you refund the bond. Then if you find that the present value of the inflow is more than outflow, then you will refund. Are you understanding? So which means initial outlay, if I decide to refund the bond, what I should pay today? 300 million I should pay today, correct? Of course, yes, this is the face value you have to pay. But apart from that, there will be some premium. 4% they have told premium. But 300 million into 4%, 12 million will be the premium. You have to pay only 200, 200 plus 12, 300, 300 plus 12, 300 plus 12, 312 you have to pay. Are you understanding? This is the amount, total amount you need to pay. Okay, the principal portion with the premium you will redeem, correct? Next, gross proceeds of new issues, but this is amount you will pay, this will be your outflow, but apart from that you will issue new bonds. The new bond sort of proceeds you will receive, that will become your inflow. See, if you decide to replace the old bonds, what you do? You pay back the old bondholders some amount, that is with premium 312 million, and from the new issue you will receive something. What you will receive? Okay, gross proceeds 300, but of course out of that 6 will be the issue cost will be reduced. 294 I will receive, 294 million I will receive. I am paying 312. I am receiving. This should be cost. So minus 312. I will receive 294. What is my net outflow till now? 312 minus 294, which is 18. Net outflow is 18. Keep in mind. Okay, one more adjustment is there. Tax savings on call premium. Very simple. I'll tell you what it is. See here. See, what happens is you have paid some premium. You have paid a premium. How much is the premium? Please tell me what is the premium? 12 rupees is premium. Correct? This will save you tax, which means this is expense. This premium will be instantly debited to your P&L. Are you all understanding? This call premium, okay, is paid for closing out the old bonds, which means the premium. What is the treatment in the P&L? You will debit off. Okay, this is P&L now. What do? You will debit this expense, correct? Instantly, everything you will debit, the entire 4%, 12 million, you will debit this portion in the P&L. Are you understanding in one shot? That amount will, if you debit this entire 12 million today, you will have corresponding tax savings on this, at the end of the period. Actually speaking, the tax savings will happen at the end of the period. You should ideally discount it back and bring it to present value terms. But Institute has taken a stand that it is also assumed, the tax savings on this call premium also assumed to be at present value terms. They have not discounted it anyway. Okay. Which is assumed to be present value term. Real tax benefit will arise at the end of the period when you file the tax returns. Okay, that is when it will happen. But of course, they have taken that this premium, when you debit instantly, you will receive a tax savings, which means how much is the tax saving? 30% is the tax, not 12 into 30%. 12 into 30%. How much is that? Okay, yes, this is there. 12 million will be debited. Yes. Apart from this, one more thing is there. What you will do? The 9 million, which you see here, the 9 million. Okay, the unamortized portion, the 9 million is there now. See here, 1 second, I'll just show you. Okay, see, can you see now? The unamortized portion of 9 million is there now. This 9 million unamortized portion of the old bond. Now the old bond is being replaced. Entire old bond is being refunded. Up 9 million. What is the treatment for this 9 million? Whether you will continue amortization or no need. Instantly you will debit to the P&L on the date of refunding the bond. Correct? Up what do you do? The 9 million also will go to directly to P&L. Here I have one more item in the P&L. What is that? 9 million. Correct? One more thing is there. 9 million is there. So 12 million and 9 million, both these expenses are debited. Corresponding, okay, credit tax savings will be there. 12 plus 9, 21 million into 30%, which comes to 6.3. This is inflow, outflow, inflow ideally, because tax savings, this you need to consider. If you refund the bond, net outflow 294, net inflow 6.3, and today 312 minus 294 minus 6.3, okay, you will have a net outlay, net outflow, which means say minus 312 plus 294 plus 6.3, ideally minus 11.7 is the net, which means it is in outflow terms. 9 minus na, so it is in outflow terms. Net outflow comes to 11.7 million. Are you all understanding till now? This is calculation. All these things happen today. This is something similar to discounted cash outflow. Discounted cash outflow, which you compute for capital budgeting. Everything, these transactions happen today. But apart from that, okay, what is the benefit arising from this? We need to see. This is the cost, net cost arising due to this transaction. What is the benefit due to this transaction? See here what happens. Savings in annual interest rate. The purpose of, okay, the real purpose of calling back the old bonds and replacing it with new bonds is the savings in interest rate. Are you understanding? Every year old bond, I need to pay how much percentage interest? See here what happened. Yeah, see, every year what happens is that you need to pay, yes, the new interest rate is 10%. Okay, old interest rate is 12%. Every year you had to pay 2% extra interest. This 2% extra interest you will save for a period of 6 years. Every year you will save 2% interest rate. Okay, till 10th year, which means 6 more years. Assumed to be 10 years. 6 more years you need to, you will save 2% interest. That is the net inflow. That is what they have given. Saving in annual interest expenses, which is 300 million face value, I will save, because new bond is also 300, old bond was also 300. 300 only you will compute interest into, okay, the additional savings in interest now, only the differential amount, 12% minus 10%, which is 2%. 2% into 300 million, 6 million, you will get the savings. Are you understanding? This is the savings in interest expense. Apart from that, see what happens. Now, tax savings on interest as well as amortization will be there. There will be tax savings on interest as well as amortization. How this is happening? Amortization on new bonds. See what is happening. Very simple. This interest, you save 6% interest now. Here you will have, see what is happening. You will have tax see this interest, if this is income, expense, this is additional income. This will have tax expense, corresponding tax expense will be there. How much tax expense will be there? You tell me, children, what will be the tax expense? Very simple, 6 million will be there. Take out your calculator. See, the tax benefit will be 6 into 0.3. Of course, how much is that? 1.8, which means the 1.8 is the corresponding tax benefit of the 6. So here institute has presented this cumulatively. I will present it in a different manner so that you can understand it better. 6 million is the annual interest savings, savings in interest minus corresponding tax. It is an extra benefit, it is interest income saved. Okay, you will have corresponding tax. How much? 6 million into 30%, 1.8 will be the tax, 30% tax rate, so 1.8 will be the tax. So after tax savings in interest is 4.2 million. Real savings in interest is only 4.2 million. Till now you understood? Okay, now see what happens apart from that. Savings in tax savings on amortization is there. Very simple. Earlier, okay, if bond was not at all refunded, assume if the bond was not refunded, how much will be the amount? See, 9 million being unamortized portion of issue cost of old bond. The 9 million, okay, old bond unamortized portion, correct? Balance 6 years is pending. Every year, how much you will amortize? Very simple, 9 million. If I don't refund at all, 9 million is the unamortized portion. Balance years is 6, but 9 divided by 6, 1.5 million. Okay, I will amortize every year if the bond was not called back. Are you understanding what I am trying to say? If my bond is not at all called, old bond is not replaced, I will have to amortize, okay, every year I amortize 1.5 million, correct? Now, because of this calling back, what happens? Because of this callback, okay, what happens? You need to understand. I need to amortize only 6 million. What is the, yes, the issue cost of the new bond is only 6 million. Are you understanding? The issue cost of the new bond 6 million, which will be the new amortization over a period of balance 6 years. Very simple part. This is old bond. I'll show you. See, this is old bond, new bond. Okay, what happens here is old bond carry the unamortized portion of the old bond was 9 million expense, correct? Agreed? Either 9 million for 6 years. If you amortize, you will amortize 1.5 million per year. 1.5 million every year in the P&L. You will debit 1.5. Are you understanding? Now, if you don't refund the existing bond, if you refund the new bond, what happens? Okay, the old bond instantly 9 million is debited to P&L. That is there. But new bond issue cost is 6 million only. The 6 million will be debited for the balance 6 years period, which means 1 million only per year. Are you all understanding what I am trying to say? So the 1.5 million earlier you used to amortize, but now you are amortizing only 1 million per year, reduced cost in the P&L. Are you all understanding? Reduced amortization, it will increase tax savings, decrease tax savings. You tell me, children, what will happen? It will decrease the tax savings to the extent of 0.5, 1 million. This is 1 million, not 1 month, 1 million, 0.5 into 0.3. How much is that? 0.5 into 0.3, 30%, 0.15. 0.15 is the tax savings, additional tax savings, because earlier you would have debited 1.5 million. Instead of that, reduced debit. Okay, what will happen? Increased debit, there will be tax savings. Reduced debit, there will be reduction in tax savings. Apo 4.2 million after tax interest expense. If you reduce the tax, you will get 4.2. In the 4.2 also minus 0.15. Okay, which is nothing but the reduced tax benefit. Okay, reduced tax benefit. What you get? 4.05. This you need to consider, sir. I may ask, sir, what you debit is only relevant. Further years you are only debiting 6 million, right? 9 million you are not anyway debiting. How this is considered? What is the differential? Very simple. Decision making process. We will consider the opportunity cost also. Here also, okay, this is relevant because incidental amount only you need to, incremental amount only you need to compute for NPV decision making, correct? So earlier what you did and what you have now, what is the difference you will compute. Okay, because of this decision only it is getting affected now. So this is a relevant number. So 1.95 they have added cumulatively, here 6. Okay, plus the 6 is directly taken, 6 into 0.3, which is already considered in 1.8 net of interest expense. Then 9 minus 6 divided by 6. Earlier 9 was amortized, now revised amortization only 6. 6 by 6 came to 1, 9 by 6 1.5, the differential amount 0.5 into 30%. If you apply, you will reduce the savings from 4.2, you will get 4.05. Now tell me children, what is this 4.05? Is nothing but annual net cash saving. Annual net cash saving. Don't, because all these number will happen annually. Interest saving will happen annually. Annually you will amortize there also tax savings or the reduced tax benefit will be happening annually. Every year it will be reduced. Therefore the 4.05 is annual tax benefit. Now if you want to discount, you will discount using annuity factor. That's why this is relevant. Okay, 7 years, 6 years, for 7%, 6 years annuity factor, present value annuity factor, how do you find? 1 divided by 1.07 is equal to 6 times if you press. Okay, GT grand total, if you press in the calculator, you will get the 4.766 annuity factor you should consider. Okay, you will find out. Now you tell me what is happening. Present value of net cash savings is 19.3 million. Very simple. Here we got already tax saving, yes, 4.766 into 4.05, you will get 19.3 million. Okay, net cash input, present value of net cash out, discounted cash inflow value less initial outlay, discounted cash outflow 11.7 million. How much is that? 7.6 million, which means this is the benefit, cost benefit. If I refund the bond, this is the extra benefit I will enjoy in present value terms. This is the present value terms. I am enjoying the benefit now. So therefore bond should be refunded. What is the decision? The bond should be refunded. If this number comes to negative value, okay, it is prudent to not refund the bond. Are you understanding? Sorry, this is the question, very very important question, market as important. Question number 25, very important. Okay, now the following data are available. This is convertible bond question, I think. No, normal question only, very simple. Duration, YTM duration, volatility based question, standard question. This is also important. They usually ask this type of question. Okay, MCQ sure short they can obviously they can ask these type of questions. Face value is 1000, coupon rate is 16%, yield to maturity 6%, and redemption value 1000 redeemed at par, and yield to maturity 17%. Now see, coupon rate is 16%, yield to maturity 17%. To find the value, what you should take for discounting? 17%. YTM should be taken and not coupon rate. Coupon is just for computing the cash flows, bond cash flows. Say, what is the current market price? Of course, see, I told you bond triangle, bond cash flow will be always given anyhow. And if they want to ask value, they will give you YTM and they will find ask you the value or current market price, fair market price, whatever it is. Or if they want you to compute YTM, they will give you the market price and they will ask you to compute the YTM. Here in this question, straightforward, they have given YTM. Okay, not a YTM computation question, and they have asked us to value the share, which means current market price, current fair market price. See, also, always in the market, the bond need not trade in the quoted market price, maybe something different than fair value of the price. Are you understanding what I'm trying to say? The yield is given as 17%. If I earn 17% yield for this instrument, what will be the market price? Yield is derived. You need to understand, in the real terms, yield will not be given straight away. Yield is actually computed by taking the current market price as reference. Are you understanding? Current market price will be taken, that is the outflow. Then you have inflow from the bond cash flows. Okay, IRR from the bond cash flows, you will compute this discounted. The IRR is nothing but a rate at which the discounted cash inflow equals to discounted cash outflow. Okay, obviously YTM itself is derived from the price of the bond in the market. That is what I wanted to communicate. What is the current market price now? You will compute. Okay, duration and volatility of the bond, calculate the expected market price. If increase in required yield is by 75 basis points. Very simple. Market price we need to find out, duration as well as volatility, and using the volatility, expected market price. If the yield is increased by 75%, using the volatility, you will find the approximate measure. I already told you that, okay, the volatility is also called as modified duration. Volatility is also called as modified duration, which is an approximate measure to find out the change in price with regards to change in YTM. But the accurate measure is calculated using a method called as convexity. The bond convexity is a curve. Okay, it will be a curve in nature, and of course convexity will give you accurate measure. This will give you only expected market price variation, which means approximate market price, right? We will take up the solution now. See, market price very simple. You discount using 7% for 6 years, 160 coupon and 1000 redemption. You will get the market price as 964.24. Are you all understanding? Next to duration computation. Here only I want your attention. See, duration in tabular there is two method, tabular method and formula based method. Formula you don't need to by heart at all. Very simple. Duration is nothing but a time period. Okay, something similar to average due date in your accounts and intermediate, or you can say it is nothing but discounted payback period, which you studied in capital budgeting now. Discounted payback period, which means, see, very simple. You have invested, how much you need to invest to buy the bond? 964.24. This will be the outflow. To initially to buy the bond, how much you will pay? 964.24, which means if you pay 964.24, by how many years the principal portion of this is nothing but principal portion of the bond, clean value of the bond, I call it as clean value of the bond. How much years it will take for me to recover this 964.24 is what is duration. See, I'll tell you, the duration is not the maturity. Maturity is something different, duration is different. In this question, the maturity is 6 years, the bond is having maturity period of 6 years. But duration is computed, duration will be computed in percentage of years, it is years, it's nothing but years. This is 4.247 years. What is this 4.247 years? Okay, this is nothing but duration. Duration is not the bond of the maturity. Only in case of zero coupon bond, the duration will be exactly its maturity. This is a coupon paying bond, hence the coupon every year you receive. Today you paid 964.24, every year you receive some coupon. Because of this coupon, you will, you will be able to recover some portion of this principal. Are you all understanding? What is this 4.247? This is on an average within how much time I am able to recover my price which I paid for this bond. This is what is duration. Are you all understanding how to compute it? Very simple. Here cash flow, present value factor, and value. This will remain same. Up to these four columns will remain same. Up to value computation, everything will remain same. Here cash flow, present value, discounted, present value factor, discounted cash flow. These columns will remain same. Apart from that, two more columns you will add, proportion and weighted years. Very simple. What you have to do? See, this is the total value of the bond. In the 964.4, you arrive at the value after discounting all these cash flows using present discounting factor. You discount it, you arrive at the present value of 964.4. Okay, now out of this 964.4, every year you are getting every year you receive 160 rupees of coupon. See, at the end of year 1 you receive 160 coupon, but the value of 160, either 160 you will receive at the end of the year, which means if I discount and bring it to present value terms, it is nothing but 136.8. The 160 which you receive as coupon will contain two portion, principal as well as interest. Are you all understanding? Interest is being paid for the compensation at time value of money. So 160 rupees out of 160, 136.8 is the principal portion of this interest, and interest to interest, the interest portion of the interest coupon of 160. How much is that? The balance amount. Okay, the balance amount 160 minus 136.8 will be the interest portion for this amount. Now when you find the proportion of the bond, you need to see, even though 160 is paid by the company, out of this our principal portion is how much? 136.8. this is getting recovered from the total value of the bond of 964. Proportion, how you need to compute? 136.8 divided by 964.4. Like this, you will find the proportion of each year's present value of this recovery. 160 is getting recovered, but present value of this is 136.8. What is the proportion of this 136.8 to the total value of present value of 964.8? Are you understanding? You will find out 0.142. Like this, you will find out for proportion. Everything you will find out. Next, last column, this proportion you multiply it with first column number of years. First year, this is the proportion. 1 into 0.142, which is 0.142. 2 into 0.121, 0.246. Like this, the years become your weight, the proportion, and you find out, multiply the years with proportion, weighted proportion you will get. The last column is nothing but weighted proportion. Are you understanding? So weighted average number of years, to recover the principal portion of 964.4 of the bond fully. This is the time period. This is nothing but time period. 4.247 is the duration. This is how you compute. Formula based computation I am not discussing, because tabular format you can easily compute it. Are you understanding? This is alternative way of presenting same thing. This is, I think, easier than that. No issues. And there is also formula based approach, which of course shortcut formula is there, which of course I am not discussing. anyway, and no need to by heart all these things, is simple. Okay, next, volatility. What is volatility? Is very simple. Duration divided by 1 plus YTM is nothing but volatility. This is called as modified duration or modified duration. See what I'm saying. The first duration is there, na? See, this is there. This is also duration. This is Macaulay's duration. This is also called as Macaulay's duration. And this one, okay, is also sometimes called as duration, which is modified duration, which is called as modified duration. This is also approximate method. Formula is nothing but the Macaulay's duration divided by 1 plus YTM. See, very simple. For computing duration, you need to find the value of the bond. Initially, you need to find the value of the bond. Then you need, so value of the bond, how will you need YTM for value of the bond. YTM given, find value of the bond. Then value of the bond is important to find duration because proportion to total value you need. So you will find out proportion and find out the duration of the bond. To compute modified duration volatility, you need a duration. You need to compute Macaulay's duration first, so that duration divided by 1 plus YTM will give you the volatility modified duration. 3 point, this is what percentage or years percentage. Okay, the volatility always represented in percentage terms. What is volatility? Very simple. Volatility is nothing but a measure of sensitivity, okay, of the bond price with respect to the yield, YTM. Okay, if YTM changes by 1%, what is my percentage change in bond price is what is captured by volatility. Very simple. Yeah, in equity valuation, the portfolio management, we would study beta. The concept of beta in case of equity or in case of options, okay, delta hedging, where we will learn delta in Greeks, correct? The delta, what is for option and what is beta for equity is nothing but volatility for the bond. Are you all understanding? Volatility for the bond is similar to beta and delta in equity and option chapter, correct? What it captures, na? Change in bond price, the percentage change in bond price with respect to divided by percentage change in YTM. If YTM changes by 1%, what will be my percentage change in bond price? Okay, YTM and bond price or value will be inversely proportional, which means if the YTM is increasing, bond value will get reduced. If YTM is decreasing, the bond value will increase. Okay, this is what they have done. YTM is nothing, volatility is nothing but duration by YTM. They have computed 3.6258%, which means if bond YTM changes by 1%, if YTM increases by 1%, see, what is the interpretation? I'll tell you. If YTM increases by 1%, the bond price will inversely approximately change by 3.6258%. I stress on approximate because, okay, convexity is there. Okay, that will be the accurate measure. This will give you only approximate measure. Convexity question is there. I have covered in the revision video. You can go through the revision video of the bond valuation chapter. There I have covered a convexity concept. Here in the study material, they have not at all given. Okay, question, they have not given any question regarding convexity, but they have asked 2 times in the examination. November 21st time they have asked the convexity there. Okay, in my and subsequent RTP also they have given. In my revision video I have covered the convexity concept. Go and revise. Okay, that is the next question. What they were asking, B part, what is the current calculate the expected market price if the yield is required yield increase in required yield by 75 basis point. Basis point na 100 basis points is 1%, which means here 75 basis point na 0.75%, which means in the question very simple. In the question, if for 1%, this is the if 1% YTM increases, now you tell me what will be happening to the bond price. It will decrease by 3.6258%. Just now we computed this 3.6258%, correct? Now it will decrease by approximately by 3.6258% for 1%. Na, up a 0.75% if YTM increases, what will be the decrease? 0.75 into 3.6258, that is what they have given, and that will be, okay, what 0.75 into 3.63% on an average. 26.63 will be the 26 will be the decrease. If you reduce it from current market price, this will be the approx price. So 938.14 will be the approximate price. They have, they have directly computed. Okay, I can show you very simple. I'll show you. For 1%, 3.6258 na, up a 0.75%, okay, 3.6258 into 0.75, 2.71935, okay, 2.719% na, 2.719% is the drop in market price, which means 100%, this number 2.719, 100 minus 2.719, how much is the difference? 97.281, which means, see, if my existing bond price is how much? 964.4, correct? If my price dropped by 2.719%, how much will be the bond price? 97.281 percentage of 964.4. Correct? You apply that 964.414 into 97.281 percentage. 938.177. Okay, this is rounding off issue because they have taken also the the 21733 like this. They have taken it fully and found out the value. This is same 938.17. Are you understanding? 14 or 17, anything? No issues. Question number 26, mark it as important. Yes, already marked. Question number 27 is regarding the bond immunization strategy. Bond immunization strategy. See, this question they have given two bond to construct a portfolio using two bonds. There is a question in the RTP. There is a 3 bond question, okay, wherein you have been asked to construct a 3 bond portfolio consisting of 3 bonds, okay. There immunization question is there, one question is there, you can solve it, okay. I will explain with the 2 bonds, 3 bonds also you need to go through. I might have covered in the revision video. Yes, I think I have covered in the revision video. You can go through. Okay. Anyway, Mr. A will need 1 lakh after 2 years, for which he wants to make one-time necessary investment now. He has choice of 2 types of bonds. The details are as below. Face value given, coupon, years to maturity, current price, current yield, everything is given. Okay. Advise Mr. A whether he should invest all his money in one type of bond or he should buy both the bonds, and if so, in which quantity. Assume that there will not be any call risk or default risk. No issue. See, this is the you have to understand bond immunization. Again, if you are not comfortable with the bond immunization, go listen and first listen the revision lectures and then come back here. See, bond immunization strategy, what you are going to do. Very simple. See, what there's the crux of the discussion. I'll just share the crux of the discussion. The bond, okay, you should invest in the bond. You should hold the bond. You should invest in the bond, not till the maturity period of the bond, okay, but only till the duration of the bond. This is the duration. We computed duration. For example, in our question, the previous question, we got some. Yes, in this question, see here, years to maturity is 6 years. Years to maturity is how much? 6 years. Correct? Duration is how much? Only 4.217, some number here. Okay, 4.2 years. Now, from 242 or some years we computed. Now, the maturity period is 6 years, but duration is 4.217% to some number, 4.2 years. Now, what they are saying, you should never hold a bond till its maturity, but only hold the bond till its duration. It is also, the duration can be understood in 3 ways. Okay, I have explained there. It is also called as an optimum bond holding period. It is also an optimum period, okay, bond holding period, which means you should never hold the bond beyond the duration. Are you understanding? Even though 6 years bond is 6 years, life of the bond. See, life of the bond is 6 years, but duration of the bond may be something lesser than 6 years, but you should only invest till duration of the bond. Why? Because I am not here to explain all these things. I'll tell you the crux. See, if you hold the bond till duration, you will never get exposed to interest rate risk. If you hold the bond till maturity, okay, till the life of the bond, you will, okay, your yield will be getting affected due to the market interest rate changes. How it will get affected, interest rate changes, how it will impact everything there I have covered. Revision videos I have covered. Here, you need to understand that, so optimum bond holding period, one line summary is optimum bond holding period is till the duration. So, in the bond immunization strategy, what is you are really discussing? What is immunization? It is a strategy by which you are protecting your yield. What is bond immunization strategy? Strategy by which you are protecting your yield so that your yield will not getting, your return from the bond will not get affected due to the market interest rate changes. Market interest rate changes every 2 months, RBI comes up with interest rate changes, interest rate, correct? Due to this interest rate change, your yield will stand protected only if you invest till duration and not till maturity. Profound discussion there I have covered. No need to again cover here. I am just telling you. Now, if you go to the, so till, what is the conclusion? You have to invest till the duration, not till maturity. Now, the problem is here in this question, after 2 years I need 1 lakh. After 2 years I need to have 1 lakh. My future value is 1 lakh, not present value, correct? Now today I need to deposit some amount so that it matures to 1 lakh tomorrow. Are you understanding? It matures to 1 lakh tomorrow. Current yield is 10%. You will use this and discount, okay, and find the present value. Present value of this 1 lakh I need to deposit, and so that I can realize 1 lakh after 2 years. That is the issue. But point is, okay, what is the issue now? I have I need after 2 years. What is the requirement? After 2 years I require money. What is your investment horizon? 2 years, which means after 2 years I require money. So I can only invest for 2 years, which means I see the market, there are two bonds available in the market, bond X and bond Y, wherein I see that bond X is having years to maturity 1 year, which means if I invest only in bond X, okay, the maturity is only 1 year, na? After 1 year I will receive money. That I don't need, na? After 2 years only I need to receive the money. So there is one bond which is having a life of 1 year. I go to another bond in the market which is trading, okay, which is having a life of 4 years. 1 year, but my period, okay, my investment horizon is in between these two, which is 2 years. I need money after 2 years. You tell me whether I can invest in bond X? No. Whether I can invest in bond Y? No. So what they are saying, since your time horizon is not matching the duration of these two securities, now what will you do? You cannot invest in single bond which matches your duration. Is there any security available in the market? No. What you do, you create a portfolio of these bonds so that the portfolio duration matches your investment time horizon of 2 years. Are you understanding what I am trying to say? Very simple. First you compute, first step bond immunization, always bond immunization, computation, question, first step is to compute duration of the bond, so that you will compare the duration with your investment horizon requirement, and whether it matches or not you will compare and then make the decision. You tell me, children. Okay, first step, what is the first step? Duration of bond X I will compute. Then duration of bond A I will compute. Then I will see whether this is life 1 year and 4 year. I need to compute duration and compare, correct? But duration I will compare and check whether it is matching my investment horizon of 2 years. If it is not matching, I will, okay, create a portfolio of these two bonds, wherein the weighted duration of the portfolio of this bond matches my investment horizon of 2 years. Are you understanding what is the proportion that I need to find out so that it matches my 2 years? Are you understanding? So first step, duration I will compute. You will understand fully only after the discussion. See, first step, duration I will compute. How to compute duration? Okay, very simple. Duration of 1 year bond, single year duration. Okay, everything will recover at the end of the year. So duration is 1 year. Are you understanding? Present value of this 9, proportion will be same. Yeah, 1 year. So everything will be recovered at the end of first year only. Nothing is getting recovered earlier. So duration will be simply 1 year. 1 year bond duration will be 1 year. Next, come to bond Y. Bond Y duration, you tell me, children, 4 years are there. Coupon, okay, is there. Redemption and coupon, everything they have put the bond cash flows, discount at 10%. Proportion. Now you tell me how to compute proportion. 72.72 divided by 936.42. Like this unit, you should not take 80. Are you understanding? This unit will be very clear. The proportion also should be present value. Okay, every year the present value of this amount, 80 rupees, how much you are getting recovered for at the end of each year, that with respect to the total present value 936.52, you will find out the proportion. 0.077, all this proportion you will find out, and then weighted duration come to 3.563 years. Now tell me whether this matches your investment time horizon. No. Upon duration of the bond A is 1 year, that also doesn't match. Duration of bond Y 3.563 years, that also doesn't match with our requirement of 2 years. What I do, I construct a portfolio. Okay, now in the portfolio consisting of these two security, bond X, bond Y. But what is the proportion? I don't know the proportion. That only you need to find out. See, you need to find out, see what they're asking, you see, as to period of investment, this question, advise whether he invest all his money is one type of bond or he should buy both the bonds. Anyway, all his money, one type of bond, he cannot invest. Why? Because no single bond, okay, the duration of bond X, neither the duration of bond X nor the duration of bond Y is matching your investment time horizon. Hence, what I do, okay, I create a portfolio of these bonds so that it matches my duration, which means, okay, I create a portfolio. I buy both of these bonds. In which quantity I should buy, which means the proportion or the number of bonds I need to buy, they are asking the number of bonds to be bought back. For that amount they have given, for that proportion you need to find out. Proportion we will find out, then we will find out the current market price, how many shares is to, how many bonds is to be bought really. Okay, what should be the quantity, we will find out. Very simple. See here. First, we will construct a portfolio using these two proportions. Very simple. You tell me, if let X1 be the investment in bond X and bond Y, see, your portfolio consists of only two security, X and Y. If X is the proportion of bond X, okay, X1 is the proportion of bond X, then Y's proportion is 1 minus x1. Are you all comfortable? 1 minus 30%, if bond x is 30%. Now, obviously 100 minus 30, 70% will be the proportion of the bond y. Correct? This, okay, you will apply x sort of proportion. Let x1 be the proportion of x. Okay, this into, see, what is weighted duration? Weighted duration of the portfolio is how much? Proportion, this is weight of x into x1. Proportion, that is x1. Weight of x into duration of bond 1. Duration of x plus, this is nothing but portfolio beta. Portfolio beta is nothing but weighted average beta of individual securities inside the portfolio. Weight of, here also, weight of x into duration of x plus weight of y plus into duration of y. 1 minus x1 into duration of y or duration of y. How you will compute this amount? Okay, see here, x1 into 1 will be same as x1 plus 1 minus x into 3.563 equated to 2, which means this is weighted duration. This weighted duration should match your investment horizon of 2 years. Are you all understanding the equation? How you form, you understood? Once you form the equation, that is simple. Thereafter, there's nothing to solve. Are you all understanding? Weighted duration, this is the weighted duration. This duration should match your investment horizon of 2 years. Correct? Because, see, individually, there is no security which is having duration which can be matched with your investment horizon. What do? You find out weighted duration of these two securities so that, okay, your investment horizon matches with that. Correct? Upper x1 proportion of, if you solve this equation, you will get proportion of x as 0.61, proportion of y as 0.61, 61%, proportion of y is nothing but 39%. Are you understanding? Up amount of investment, present value of 1 lakh for 2 years, 10% discounting rate, current yield you will take and discount anyway. This is the amount, very simple. But how much amount? 61%. Up 1 lakh is there, discount it, bring it to present value term. Okay, into 61%. This is the amount you need to invest today. See, very simple. 1 lakh into, I'll take the calculator, 1 lakh into, okay, what is the present value factor for 2 years for 10%? 0.826. So 82,600 is the amount of investment you need to make today. Are you all understanding? If you make the investment of 82,600 today at interest rate of 10%, after 2 years it will mature to 1 lakh, which is your requirement. Correct? Up today present value 82,600. Out of this 61%, okay, you need to invest in X. What is the value of this 61% of 82,600 into 61%? How much is that? 50,386. This is the amount of money you need to invest in bond X. Into 39% of 82,600. How much is that? 82,600 into 39%, 32,214. 32,214. Are you all understanding this? Now, this is the total amount. Correct? Now, what is the current market price of the bond X? Okay, which is 972.63. If you divide the amount by price, you will get the number of bonds or number of bonds, 52 bonds. Are you all understanding? See, very simple how they have done. Present value of 1 lakh for 2 years at 10% will give you 82,600 into 61% will give you 50,363. This is the amount to be invested in bond X. This is the amount to be invested in bond Y. And okay, divided by share price, the bond X price. Here divided by bond Y price, you will get the number of bonds to be bought. Here also the number of bonds to be bought today. The investor has to keep the money invested for 2 years. Therefore, the investor can invest in both the bonds with the assumption that bond X will be reinvested after 1 year, the same return. Further, the above computation, modified duration can also be used instead of duration. Okay. So this will not be accurate. You have to compare duration, okay, not modified duration. Volatility, of course, volatility is an approximate method. Here, duration is accurate method because duration is computed using intrinsic value. Hence, this is, don't give priority. This note's not required. If you compute this is perfectly fine. Okay, I don't understand why they have given the note. Okay, therefore, the investor both bond assumption that bond investment we reinvest in another year with same return. Of course, see, this is not at all required to be told because the YTM has an inherent assumption that the amount will be reinvested back at the same rate of YTM. Okay, otherwise it is not at all will be called never called as YTM itself. Are you understanding? YTM now it is IRR. IRR will have the underlying assumption that the cash flows will be reinvested at the same rate of IRR. Then only it is IRR. Okay, these things you need not explain. Okay, there's a question number 27 stands solved. Okay, very important question. And of course, I have told you now one more question is important. There you can go through. Next question number 28 is regarding the short-term securities, money market instrument. Okay, money market instrument. What will happen? Very simple. Money market instruments or short-term securities, T-bills, commercial papers. All these things are there, na? Okay, it will generally be issued at discount, and redeemed at par. Okay, you have the zero coupon bond, that is also similar. Okay, it will be issued at discount and redeemed at par, and the differential amount will be the return. The differential amount will be the return for those many days. It will be annualized and published. This much is the per annum basis. The returns will be always published on per annum basis. The return which you will compute for respective days in a short-term security, suppose 91-day T-bill. Okay, short-term securities, 14 days T-bills. All these will be there. Government securities. Okay, RBI will issue these short-term securities, which means for 14 days or for 91 days, you will compute some return. This you will annualize. Into 365 by 91. If assume to be 360 days, they will give in the question, whatever it is, you will assume and then annualize and show the return in the annualized terms. Now, in case the annualized yield is given as 6% in supposed question, what you will find? You will need to find out the issue price. At what price it has been, the bond has been issued. Are you understanding? We will find out. See the question. RBI sold 91-day T-bill for face value 100 at a yield of 6%. What is the issue price? Very simple, straightforward question. See what is that? Issue price be X. Okay, you will assume and equate it to 6%. Very simple. You see what is happening now. While computing this return, okay, the bond will be issued at discounted price na. So the discount issue price will be X na, something below 100, correct? It will be below 100, assume 97 is there. So how will you compute yield first? Very simple. Yield they have given us 6% and they ask us to compute issue price. Issue price, see, very simple. If issue price is given, what you will do? 100 minus this issue price divided by issue price will give you the return for these many days, correct? And what you will do? Assume this is 91 days. This will be the return for 91 days. But you want return for 91 days. Annualized return into 365 by 91 you will do. Agreed? This is what they have done. Assume this as X. 100 minus X. Okay, by issue price into 365 by 91. This annualized yield is given as 6%. You equate it to 6% and is equal to 100 minus issue price divided by issue price into 365 by 91. Okay, solve it. You will get the excess 98.53, which means here 100 minus 98.53 divided by 98.53. This will be the initial investment amount. You buy the security using this amount. This will be the return portion, the differential portion. Okay, it will be issued at discount, redeemed at par. The difference that will become the numerator or return, correct? But this will be returned for 91 days. You need annualized return. So into 365 by 91 you do and equate it to 6%. They have given 6% yield, annualized yield. Okay, say unless they give you specifically in the entire subject, unless they give you specifically for yield for this many days, okay, you should not consider the yield to be for respective days. You should only consider it to be annualized yield. Are you understanding? Say interest rate also same. Wherever they give simply interest to 6%, okay, it is assumed that it is interest rate per annum. It is 6% per annum. Are you understanding? The significance is there. That is why I am stressing. Next question number 29. Yes, Wonderland Limited has excess cash of 20 lakhs, which it wants to invest in short-term marketable securities. Okay. Expenses relating to investment will be 50,000. Securities investment will have annual yield. They are straight away given as 9%. No ambiguity. Okay, the current company seeks your advice as to the period of investment so as to earn a pre-tax income of 5%. Okay. Now, the minimum period for the company to break even its investment expenditure over time value of value of money. Okay. No issue. See, first part, they have excess cash 20 lakhs. They have excess cash 20 lakhs. They need to invest this 20 lakhs. Agreed? They need to invest this 20 lakhs. And the expenses related to this investment is 50 lakhs, which means you should earn a return over and above this 50 lakhs so that you will adjust this 50,000 and earn some extra income so that it can cover the expense also. Are you understanding? This you need to think. Then it will yield 9%. Okay. So what return as to period of investment, for how many months this short-term security, which means 1 year will be the maximum, so over and above 1 year, okay, it is called as long-term security generally. So the maturity period will be less than 1 year. In case, okay, I need to invest for how many months or how many days so that I can earn a pre-tax income of 5% using this instrument, which is yielding 9%. See, annually. See how they have done now. Very simple. Requirement is 20 lakhs. Okay, this pre-tax income which is required on investment is 20 lakhs. See here what they've done. Okay, pre-tax income of 5% which you need to earn, correct? Now see what is happening here. 20 lakhs is the amount, okay, required pre-tax income required on investment of 20 lakhs, investment of 20 lakhs. This is the not the income required on investment, this is 20 lakhs the investment amount, correct? Let the period of investment be B, no issues, they have assumed to be P, and required amount is 1 lakh. Very simple. 20 lakhs is the amount into 5% you require the return. 20 lakhs into 5%, 1 lakh you are getting, na, correct? This 1 lakh, you tell me children, what is there, na? This 1 lakh you need to earn. Upon 1 lakh you need to earn over a period of how many months they are telling. See, very simple, which is yielding 9% per annum. Upon 20 lakh is the amount invested, okay, into 9%, I can put it as 9% into, this is per annum, 9% annually, correct? If you put multiply 9% or 20 lakhs into 9%, how much? 1.8 lakhs. 1.8 lakhs will be the annual income. But I need only 1 lakhs plus 50,000. 1.5 lakhs only I need, na. See, if you invest for whole 1 year, you will earn 1.8 lakhs. But you only need investment for lesser than 1 year, which means P by 12, I need to find out. 1.8 into P by 12, I will find out. How much is that? See, this some amount, okay, this is the total amount of return minus 50,000, which should also cover the expenses, na, correct? So I should earn only 1 lakh, 1,50,000, 1,50,000, which I will earn, correct? Apo minus 50,000 is equal to 1 lakh, or this minus expense I can take it to right hand side. Also I can show 1.8 lakh into P by 12 is equal to 1,50,000, so that I cover my expenses also. Are you all understanding what I am trying to say? Expenses is 50,000, okay, that should also covered by the return from the investment, which means I need to earn 1,50,000 to break even. Are you understanding? At least, see, to earn 1 lakh income, I need to earn more than, I need to earn at least 1,50,000, because 50,000 will be reduced as expenses, na, correct? Are you understanding? So 1.8 lakh is total yearly return I am earning, na, into P by 12. If you solve this, you will get 10 months, which means if I invest whole year, I will earn 1.8 lakhs, correct? But only if I invest for 10 months, I will earn 1.5 lakhs. Out of the 1.5 lakhs, 50,000 will be covered as expenses. Net balance, what I will receive, okay, net of expenses is 1 lakh income. Are you understanding? So this is what they have given. P is 10 months they have calculated. Next to what they are asking, na, they are asking the minimum period of the company to break even its investment expenditure over time. Very simple, over time. See, in the second part they are asking, what is your minimum break even its investment expenditure? Investment expenditure is 50,000. Now what they are asking, the 50,000 should be at least earned, which means in the previous part we solved how much you need to earn, how many months you need to invest in order to earn 1,50,000. In the second part they are asking how much you need, how much time, how many months you need to invest so that at least your investment expenditure, okay, expenditure related to investment can be recovered, which means 50,000 you will equate and find out the same solution. Are you all understanding? Which means 1.8 lakhs into P by 12 is equal to 50,000. You equate it, how much you are getting? Very simple, 1.8 lakhs into 50,000. Okay, P is 50,000 into 12, 50,000 into 12 divided by 1,80,000, 3.33 months, 3.33 months. Are you all understanding? Getting the solution? This is the way. So if you invest for 3.33 months in the security, your 50,000 expenditure will get recovered. Okay, that is what they are asking. Next. ZCO Limited issued commercial paper worth 10 crores as per the following details: 16th January, 17th April. Date of issue, date of maturity given, number of days, they have given number of days itself, you don't need to compute all these things. Number of days straight away given, interest rate is straight away given, annualized interest rate 12.04% per annum. What is the net amount received by the company on issue? Charges of intermediary is ignored. Very simple and straightforward. Issue price they are asking, na, simple, 91 days given, amount given as 10 crore. Assume this to be worth 10 crore, na, face value of 10 crore. Na. What will you do? Same way, okay, we solve, na. See here, 91 days, 12.04 into 91 by 365. Okay, they have taken for interest for 91 days they have computed. Then they have found out like this. Okay, you can also find out using, see, this is very simple. What is the annualized interest rate? 12.04. You can do like this, 12.04. The previous question we solved, na, same way, 12.04 is equal to, you can equate it, na. What is the amount? 10 crore about 10 crore minus the issue price. What is that? Issue price is Yes, issue price you don't know, na? So issue price divided by issue price, okay? Issue value, price is relevant. We will assume total amount to be face value. Like that you will assume. Okay, 10 crore minus issue price minus divided by issue price into 3. This is annualized, na? So 365 by 91. If you do that, if you solve this, you will get the same answer almost. What is that? Yes, 29 point. Yeah, no, this is the 9.70849. 9.70849. Shall we try solving this? Okay, wait a second. We'll try solving this. See. Yes. Please wait. We will solve whether we are getting or not. Just to verify. 10 crore minus issue price into 365. 365 divided by 91.010. Okay, into 10 crore. 4.011 into 10 crore minus issue price divided by issue price. Issue price into 12 point, what is that? 04 percentage. I can compute it. 12.04 percentage, na? Okay. So issue price is nothing but, see here, 12.04 percentage. 12.04 into issue price minus issue price, okay, is equal to minus 4 point minus, you bring it here, plus 4.011 issue price, correct? Is equal to 10 crore into 4 point, see, 10 into 4.011. How much is that? 40.11. So 40.11, okay, divided by here 0.1204 plus 4.011, 4.1314. 1314. How much is the number? 40.11 divided by 4.1314. 9.7085. This is the number. Rounding off 9.7085. Are you all getting the same value? Okay. Yes. Here I have shown. Here they have shown this working. Okay. Same working. Okay. No issue. Okay. Last question. Take question number 31. Very, very important question. Question number 31. Mark it as important. Bank A enters into a repo for 14 days with Bank B in 10% Government of India bonds 2028. Maturity date 2000. Maturity is given as 2028 at 5.6% for 8 crores. Assuming the clean price, the price that does not have the accrued interest, okay, be 99.42 and the initial margin be 2%. Days of accrued interest is 262 days. You are required to determine the dirty price of the bond and repayment of maturity. See what happens. This is a repo based question. Okay, repo and reverse repo transactions, you need to understand. So short-term security, what does the bank, okay, this is a bank A, assume this is commercial bank, okay, it lends, it borrows money from the central bank, say RBI is there, it borrows money, okay, it borrows money at the rate of repo. Are you all understanding? 3. Bank A is there, this is central bank, RBI is there, from RBI it borrows money at repo rate. Are you understanding? And the rate at which the central bank borrows money from these commercial banks is called as reverse repo rate. Okay, reverse repo. Okay, these transactions happen. Now, see, in this transaction, repo transaction, what will happen, I will explain, okay, briefly. See what happens. This bank A issues some instrument, correct? It will borrow from RBI, which means it has to issue bond, correct? It will issue some instrument. Assume it is, okay, see here, yes, it issues a bond, okay? It issues bonds and it borrows the money. It issues bond to the RBI and borrows money. Are you understanding? Here, what it does, after this, it issues us some discounted price. Assume some price here, okay, some X price, okay, it issues the bond the bond, okay, will be repurchased. This is repurchased, a repurchase agreement, na? So it will repurchase at some higher rate, okay, at some higher rate. The amount will be higher than the initial purchase price. Are you understanding? Which means it issues some, assume it issues at 98 rupees. It issues the bond at 98 rupees. After some days or after some specified period, it will, okay, buy back the bond, which means it will pay. Now they are receiving bank A. Initially they issue bonds and receive money, correct? They receive money. After a few days, what they will do? They will buy back the bond at a higher money, okay, agreed upon. Something similar to forward rates, okay, something similar to forward. Are you understanding? So now you have to understand what is happening. This is the transaction, okay. Here what is happening? The 14 days transaction is just for 14 days, just for 14 days, and this is one part. This is the repo arrangement, correct? Here one more thing is there. You need to understand that there is clean value and dirty value. Okay, this I already explained the underlying concept in the bond valuation last segment. If you see there, I have explained. Okay, in the revision video also I have explained. Very simple. See, if you are buying a bond in between some year, assume that the bond is paying annual coupon rate, and you are buying, one investor is buying the bond, okay, December 1st he is buying the bond, correct? On December 1 he is buying the bond, assume. Now the problem is that the new person who is buying on December 1, after 4 months he will receive interest. But this interest, you tell me whether he will receive only for 4 months, he will receive for the entire month. Are you understanding? Just like in shares dividend, the person on the record date whoever is holding the share will receive the dividend. Okay, full dividend he will receive. But the point is, okay, something called as a dividend equalization levy you studied in mutual fund, same way here also. See what is happening. The 1 year bond interest will be paid annually, right? But the person who is purchasing the bond in between, right? Okay, he will receive the entire interest, but which doesn't belong to him. Are you understanding? So there will be some accrued interest portion. For that also the person should pay the compensation, which means the clean value of the bond will never be including the interest portion, which means we call it as dirty value. Dirty price of the bond is nothing but where accrued interest portion will be added to the clean value of the bond. This I have explained the underlying concept there, you can go through. Now the point is, okay, here what they are saying, 14 days, the repo arrangement is made for 14 days, 10% is the interest, okay, 10% is the coupon of this Government of India bonds. That is not an issue. At 5.65% is the rate agreed upon for this is 5.65% per annum, okay, but for 14 days only you need to compute. This is how the arrangement happens for 8 crore. 8 crore is the value of the borrowing or what do you say, the issue of the bond. Assuming that the clean price which does not have accrued interest is 99.42. See, they have given, and initial margin be 2%, and the date of accrued interest comes to 262 days, which means very simple. Dirty price is nothing but clean price, okay, plus accrued interest, which means now clean price they have given 99.42. okay, accrued interest we have to find out. Accrued interest, very simple, respective, see here 99.42 is the clean price plus, okay, 10%, 100 into 10 by 100 is annual, assume to be, the face value is assumed to be 100 in this case, because 99.42 clean value is around 100, so they have assumed to be 100. Here they have given anything about face value, nothing given in the question as such, which means we will take par value as 100, which means 10% is the interest on 100. Now 10 rupees is the interest, correct? Assume the annual coupon is 10 rupees. Now how many days, this is yearly interest, how many days accrued interest? 262 days, assumed to be 360 days per year. In the question given there, they have given that you should assume 360 days per year. So how much it is coming? 10 into 262 by 3, 106.7. This is the, okay, total amount. You see, this is here in the 106.7 you have 99.42 as clean price, and the balance as accrued interest for this many these many days. 10 into 2620 divided by 360, can you just work it out? 1 second. 2620 divided by 360 is 7.27. This 7.27 plus 99.42, okay, 106.7, roughly rounded off, 106.7. Are you all understanding? 7.72 Okay, this is some number here, 7.72 or something. This is accrued interest portion. Okay, simple. So dirty price is nothing but clean value plus accrued interest portion. Clean price plus accrued interest portion. Now, the first leg, start proceed. See, what is this first leg now? I told you in the repo arrangement, you have two legs. First, initially, okay, the the bank which is borrowing the money, it will issue a bond at some price and then later repurchase the bond. This is called as first leg. Okay, first leg of this transaction. This is second leg. Are you all understanding? Now, first innings, second innings, test match. Okay, see here what happens. Here, nominal value into dirty price by 100, 100 minus initial margin by 100 is nothing but, see what is happening. This the value of face value, in the sense the value, base value of the borrowing is 8 crore, which is 800 lakhs. This 800 lakhs, you tell me children, what happens? Okay, this is dirty price only should be considered. In the market price, see, you cannot consider clean value. I told you that the price which is quoted in the market will always be dirty price, which means interest will be accrued in the accrued interest will be included in the dirty price. Okay, so whenever I say price, market price will always be dirty price only, which includes the accrued interest portion. Now, if it includes the accrued interest portion, if you include the dirty price, what will happen? 106.7, okay, will be the price. 100 rupees is the clean price. 106.7, very simple. Par value assumed to be 100. Up 800 lakhs, the total value, nominal value, divided by 100, the face value if you take. Okay, how much you will get? 800 lakhs divided by then you will get number of bonds. Correct? 800 lakhs. Okay, divided by 100, 8 lakhs. You get this 8 lakhs assumed to be number of bonds. Okay, 8 lakh, number of bonds, 8 lakhs. Correct? Now, this bond issue price is 106.7. Are you understanding what I am trying to say? Which means the issue price is 106.7. Tell me children, what will be the issue price initially? Okay, 8 lakhs into 106.7. How much it is? The 85,360. 85 lakhs 360. Are you understanding? So 800 lakhs was initially there. Correct? Out of that, 800 lakhs. 853 lakh 60,000. Yeah, that is 85 million 3 lakh 60,000. Anyway, 853 lakh 60,000. This is 853 lakh 60,000. Yes, initially 800 lakhs was there. When you, okay, this is on nominal par value, but issue price, the market trade, okay, the bond will be trading at what price? Dirty price, which means that we have already computed 106.7. That you apply, okay, you get 853.60. Okay, you will get, this is the issue price, this will be issued at premium, which means it will include the accrued interest portion. So 853 lakh 60,000. Now, apart from this, you have to pay initial margin. Apo, you tell me children, when you are issuing the bond, the bank A issues the bond and receives money initially. How much money I will receive? 853 lakh 60,000 I will receive anyway. Dirty price I will receive because the other party has to pay the dirty price, including the accrued interest portion. Now 800 lakhs into 106.7, which means 8 lakh shares, 8 lakh bond into 106.7, 853.60,000 he has to pay. The central bank has to pay. Correct? But apart from that, 2 rupees initial margin will be incurred. 2 rupees initial margin will be incurred. I will not receive the entire amount because I need to pay some initial margin. Are you understanding? Here they have told, see, initial margin is 2%, which means I have to pay 2% as initial margin out of this amount. Only 98% of this amount I will receive as, so 98%, 853 lakh 60,000 into 98%, 83 652 800. Up 83 652 800. This will be the amount which I receive. Initially, I issue bond, I receive this amount. Okay, this is called as, proceeds from the first leg. Okay, this is the proceeds from the first leg. 836.52 800. Are you understanding this amount of calculation? Don't worry, I have just shown you the different way. Okay, which means dirty price will be there, number of bonds you can compute, and you will get the total value of 853.60. From there, 2% margin you will be reducing, 98% only you will release. So this bank will release how much? 836 lakh 52,800 will be received. Now come to the repayment. The bank took the money, correct, issued bond. Now it has to repay the bond. I told you the repayment it has to do. Now with interest, this amount will be repaid, but apart from that, interest will also be repaid. Are you all understanding what I am trying to say? This amount you receive as capital, that is fine. But apart from that, you receive this amount you need to add interest for 14 days. Interest for 14 days you are borrowing. This 14 days you are borrowing, na? That interest you have to pay. How much interest? Very simple, at 5.65% given in the question. So what do you do? 836.52 800 836.52 800 into, okay, how much is the interest rate? 5.65%. 47,26,383. This is annual interest. Make it 14 days. Assume to be 360 days. So 14 by into 14 divided by 365. The amount comes to 1,81,285. Are you all getting the same answer? 1,81,285.93, some number rounding off. This you add to the existing 8,33,52. Okay, 1,81,285.93 plus, okay, 836 lakhs 52,800. Okay, I am getting 838 lakhs 34,000. What is that? 838 lakhs, yes, 34,000, oh, 36,000. This is rounding off, no issue. Okay, they have done this way, no issues. This is rounding off thing. Okay, I have separately computed. They have taken this like this. Are you understanding? This is just a rounding off. They have taken the 5.65% into 14 by 360 they have done, and then they have multiplied it with this. That is why you are getting some variation, but it will give the same amount. What I have done is I have applied 5.65 to this number, and then I have multiplied with 14 by 360, all rounding off either, but ultimately you will get 838 lakhs 36,604. Are you all understanding the solution? Okay, this is what you should do for repurchase. This is the second leg when you repay. To put it simply, the company receives 836,52,800 in the first leg, correct, and issues a bond. Later repurchases the same bond from RBI by paying how much? 8,36,000. Now 838,36,604, and the differential amount is nothing but the interest. 14 days interest is the differential amount. Are you all understanding? First leg proceeds to compute, you need dirty price. Are you all understanding? Okay, but for repayment, you will see how much is the agreed upon interest rate, and that interest rate will be applied for 14 days, and you will find the repayment. Second leg you will find out. Okay, with this we are closing the session. We have revised the security valuation chapter. All the questions we have revised, and in the next segment we will see portfolio management on forex chapters. We will see. Okay, thank you.